So this is that chart that I shared. This is high yield versus the S&P 500. Comparative cycle analysis. And plainly, when the government stimulus is there, it helps corporations, especially the very weak ones, and earnings become inflated. You get real low interest rates, their borrowing costs are much lower, their earnings go up, and the rest of the economy is stimulated, so there's more retail, there's more business, and earnings become inflated by that. That's that malinvestment that we talk about. When you have a withdrawal stimulus, earnings are hurt. It puts weak companies, that's those zombies, which are loaded in the Russell, at risk. And you come to some earnings reality. That's really where we are right now. So here's that period right in here in 2020 where that pandemic rebound came, and it was very strong on Fed and government stimulus right in here as you got that big jump over here. So you have here the high yields. This is HYG, as you can see on the candlestick chart. And this is the S&P 500, the line chart right over here. And generally they follow each other. And we had this big saucer top right over here. And we've had other ones in the past that were really helpful to see. And then when this began to roll over, there was trouble. You can see in here on the bottom are our cycle brackets. This is just a drawing tool, a guide for the rhythms that we see here in the market. You could see how closely that follows. This little rally was this rising phase right over here, and then it broke down. That was really ugly. And this is that post-pandemic decline, very weak on Fed and government withdrawal of stimulus and higher rates and QT. This is the whole time period where those zombie companies have to pay more money to borrow, and their earnings are going to come down because the Fed isn't pumping the consumer anymore and pouring money into the coffers, into their bank accounts, and they're all pulling back, and the savings rate has absolutely plunged and now moving down. You could see actually a few weeks ago there was a good attempt at a rally there, but now giving that all up. What's important in here is this cycle right in here is expected to trough in August or September right over here. And this says that that stock market rebound that happened right in there and is now coming down is likely to continue out into this period right over here in this August-September time frame. And that's what we've been looking for and showing, and I'll show you that at the end of the show also as we look at the analysis on the S&P 500, that this is really the timing over here. We expect that HYG, the high yield corporates, and the stock market, the S&P 500, and all the indexes will continue to move down very sharply into this period over here, into that August, September, and potentially out into October. So I wanted to review that for you. This is a great guide that you can see, and that is really looking at these high yields. As we continue to expect, with some upside attempts, that we'll have much lower stock prices, and that's likely to happen into the fall. However, the last quarter of the year could be better. You see in here where that bottom is supposed to come, that trough in there, and you could get a rally. That'll be another time where investors' illusions of the stock market moving to all-time highs again, they come up, and investors will, of course, be buying, and we think that will happen. But the central banks have a ton of catching up to do, and we think that'll come way out into 2023. Bank of Japan, the ECB, all of them are way behind, and there's going to be rate increases well into that time frame, and a lot of discussion about that really being the recessionary time out into 2023. So we think that rates are going to continue to go up into that time frame. The stock market will continue to be weak, and we will continue, even though we see a good last quarter to the year, to be in a bear market well into 2023.